everyone, and thank you for joining us for the Let's Talk
Good
Money
morning.
Financial Wellbeing Webinar. My name is Janae Hanna, and I am the Corporate Wellness Coordinator for CG Atlantic Medical and Life Limited and the CG Zest Wellness Program. Today, we are excited to provide you with a very timely webinar on financial well-being. During this webinar, we will discuss how to create a budget, inflation concerns, planning for retirement, and creating educational funds. Without further ado, I would like to present our dynamic speaker for the day. He is the portfolio manager of Coralisle Pension Services Bahamas Ltd and serves as a member of the Investment Policy Committee of Coralisle Pension Services Ltd. He holds the Chartered Financial Analyst and Chartered Alternative Investment Analyst designations, in addition to a Master of Business Administration degree with an emphasis in finance. He has been employed with Coralisle for over 7 years and has worked in the finance industry for 8 years. He also serves as the current president of CFA Society, the Bahamas, and serves as treasurer on the executive committee of the Bahamas Financial Services Board. I am speaking of none other than Mr. Kriston Moore, who will be leading us all to financial empowerment today. Please join me in welcoming him. Kriston, you can take it away.
Okay, good morning and thank you for the welcome. Give me 1 second. Let me just share my screen. Give me 1 second, sorry. Okay, can anyone see my screens yet?
No, we can't see it as yet.
No? Okay, 1 second. Let's try something else.
Okay, while we wait on Kriston, just a few technical difficulties. Let's get to know each other. So in the chat box, let's see where everyone is from. Please open the chat box and let's see what country we all are from. My name is Janae and I'm from the Bahamas. You can go ahead and throw in your country's name in the chat box as well.
Yeah, okay, there we go. Got it. Okay, can everyone hear me?
Yes, we can hear you and we can see.
Okay, perfect. So sorry about that. We had a little bit of a technical difficulty, but I think we're good to go now.
Okay,
so,
no worries.
Thank you for the introduction again. What I'm going to do today is walk you through, I guess, an overall broad sense of financial well-being. I'm going to talk about a few different topics. I'll leave time at the end for questions. And also, I'll walk you through an interactive process to creating a budget. So today on my agenda, I want to talk about 4 things in particular. Number 1 being inflation, since that's a very pressing topic right now. Second is retirement planning. Third is creating an education fund. And lastly, budget creation. Now, I'm starting with inflation and retirement planning and creating an education fund before we get to the budget for a reason, because all of that factors into creating a budget. So I'm going to hopefully tie that all in, and hopefully this makes sense to everyone as I go along. So let's get started. Firstly, what is inflation? Inflation in general is an increase in the price of goods and services and the fall in the purchasing power of money. So what that means in a nutshell is that prices go up over time and things tend to cost more. And over time, your dollar is not worth what it used to be. In the short term, it may not impact you very much, but over the long term, it will drastically erode your purchasing power. If you think about, I guess, what a gallon of gas or a gallon of eggs, or a gallon of milk or a carton of eggs would have costed maybe 30, 40 years ago, um, it's quite different to what it is today. If you look at some of our jurisdictions, I know we have different jurisdictions on the call. So as an example, up to June last year, the inflation rate in Bermuda was 4.7%, in the Bahamas it was about 6%, and in Cayman it was about 12%. So what that generally means is that year over year, the general cost of living, well, the simplified cost of living, let's say, went up by that percentage amount. Now, how does this affect you? Number one, it affects your cost of living because, um, you know, as I've said, groceries, gas, rent, utilities, all of those things can go up over time. And of course, that will impact what you can purchase if your salary stays the same. Speaking of salary, there are pros and cons here. Um, Basically, when the economy is strong, workers have lots of jobs to choose from, so employers have to offer higher wages in order to compete. These higher wages in turn drive prices higher. So businesses will raise their prices to make up for higher labor costs and whatnot. Next, if you're on a fixed income, then what you would need to think about is that no matter what happens to the economy, the amount of money you make is set in stone. Prices will go up. Sorry. Yeah, prices will go up regardless. So you will have to make some adjustments in your budget and the way you live your life. In terms of debt repayment, inflation is actually a good thing because if you think about it, if you owe someone money and those dollars are worth less over time, then paying off debt in high inflation time periods is actually a good thing. When it comes to savings, it's not the best. Leaving your money sitting in the bank most times, if it's not for an emergency fund or something short term, is not really beneficial, especially in terms of when you factor in high inflation over time. Um, $100 today cannot buy what it used to buy even 5 years ago, based on the current inflation rates. Now, when it comes to investments, it can be a little bit tricky. Um, Inflation generally will benefit investments such as stocks because uh, prices will go up as businesses can generate more in revenue and whatnot, and over time that's a good thing. However, part of the reason the stock market did so poorly last year was due to high inflation, but that has to do with central banks raising interest rates in order to curb inflation and whatnot, which is a much broader discussion than what we're going to get into today. But in a general, there's a mixed effect on your investments. So what are the actual effects of inflation? So 40 years ago, your dollar was worth about 3 times more than it's worth today. What you needed today to equal your purchasing power in 1982. So for example, in 1982, what you could have bought with $1,000, you can buy today with about $3,000. The reason I use this time period is because from 1982 to 2022 is about 40 years. And if you think about 40 years, that's roughly the time period of the average working career. Let's say you start at 25 and retire at 65. So the point I want to make here is that inflation does matter. And this is exactly why saving for retirement, quite frankly, does not work. Um, the point I'm making is saving for retirement does not work. Not investing for retirement. Investing for retirement is great. That's exactly what I want to, the point I want to get across. But saving for retirement will leave you in pretty much the same situation that's in front of you, whereas your dollar's not worth what it was 30 to 40 years ago. Like I said, there are two sides to it. Pros and cons to inflation. It's not necessarily bad, but recent inflation levels are unsustainable. So inflation levels of 4, 6, and 12%, those are not things you want to see on a regular basis. I think most times an inflation rate of maybe 1 to 2% is good for the economy. Anything that's too high, kind of, we run into trouble. Like I said, it does drive up prices and reduce the purchasing power of your savings. But like I said, it also can drive up wages and typically boosts economic growth. So it doesn't impact everyone the same way. Some employees can use this as an opportunity to negotiate for a higher salary. Actually, my boss might be listening, so let me say that again. Some employees can use this as an opportunity to negotiate for a higher salary. Both prices and wages have increased over the years. Basically, as
I
companies.
am on this call, Kriston.
There we go. There we go.
And I'm quite capable of finishing the presentation.
Okay. Yeah, just checking the temperature, just checking the temperature. Okay, everyone, just gotta check the temperature sometimes, just making sure. But as I was saying, both prices and wages have increased over the years. So what you would like to do is factor that in. Now, on the other hand, if you're a saver or a creditor or someone living on a fixed income, you may tend to fall behind because your purchasing power can be eroded um, over time. Now, that brings us to retirement planning, which is the next topic on our agenda. So, how do I plan for it and why is it important? Retirement planning is the process of determining retirement income goals and the actions needed to achieve those goals. So, this is basically figuring out what you'll need to survive when you stop working. It involves identifying your sources of income, estimating your expenses, figuring out an investment plan and managing your assets. Now, I know we have different jurisdictions on the call. To my knowledge, I think a broad retirement age in most countries is around 65, and that can vary, but this is subject to change. I know at times, if you think about national insurance and the age for Social Security in the U.S., they always talk about whether they want to move the age up, just because they may not have enough to fund um, retirement income and whatnot from a national level. So you kind of don't want to solely rely on national insurance or stuff like that. Um, in many cases, your country's national retirement benefit will not be enough in either event. If you think about it, I don't think it's meant to be a full income replacement. It's meant to supplement your income. So you want to think about retirement planning outside of what's already prepared for you. So how do you adjust your retirement plans as you age? In general, you want to start as early as possible, but we understand, not everyone starts at the same time, so that's completely fine. Better late is better than never. Between your 20s and 30s, you want to, start investing, figuring out your asset allocation, and what that means is figuring out how aggressive you want to invest. Whether it's, you want to put it all into stocks, maybe 50% into stocks, whatever. The whole point is to figure out your asset allocation and figure out what return will get you to where you want to be in terms of retirement. Generally, the longer your time horizon, the more risk you can assume. So if you're in your 20s, 30s, and even your 40s, you can probably invest in something that's a little bit more aggressive or something that's moderate, and you'll have, it's a higher risk but a potentially higher return strategy. Now, if you're in your fixed 50s and 60s, you want to think about something a bit more conservative, so something that doesn't fluctuate as much in value and will most likely preserve the principle of your investment. So basically, in your 40s, you want to stay on track, stay consistent with your investments. If you're in your 50s, for your contributions, you want to go all in. This is the time where you want to step up your contributions, look at what you will have at retirement based on maybe a 10 or 15-year projection, and figure out, okay, maybe I've fallen behind, I need to catch up. You can do that by investing conservatively, but you're going to have to step it up a bit. Most times, I think if you're in your 50s, you may be at a point where you're earning a bit more than you were when you were younger in your career. So this is a good time to step that up. And if you're in your 60s, you want to start thinking about your income strategy, meaning, okay, when I retire, how am I going to survive? Am I going to take a lump sum? Am I going to take a fixed payment every month? Am I going to get an annuity? Something like that. But you want to figure out what exactly is going to replace your salary once you stop working. The four things you want to keep, or the three things you want to keep in mind, are to one, maintain a budget. So figure out your income, figure out your expenses. What exact lifestyle do you want to live in retirement? What adjustments can you make now to save more towards your retirement? You want to be consistent in your investing. One of the things that people don't realize is that they think, the more money you make, the better you are with money. That's absolutely false. How good someone is with money is very much dependent on their behavior with money as opposed to how much they make. There are persons that may make, six figures that may be terrible with saving and investing, and persons that may make, $20,000 a year that are absolutely phenomenal, and they will be financially secure by the time they retire. And also you want to minimize debt. Being debt free in retirement definitely reduces your expenses. You don't want to, be paying, I guess, high interest, not only high interest debt, but any kinds of debt in retirement if you don't have to. I understand it does happen, but if you can pay it off before retirement, that would be great. Sorry, in terms of minimizing your debt, the best case scenario is your mortgage, your car loans, credit cards are all paid off by the time you retire. If not, you want to pay down the highest interest rate loans first. So get rid of your credit cards. Those are typically 18 to 20 some percent. Then maybe go for your car or consumer loans, and then maybe tackle your mortgage. The good thing about a mortgage is at least, you have a home and you build equity in it as you pay that down. And also you want to avoid borrowing against your retirement savings. Not that it's, how do I say, it's not, I mean, you can, but it's not recommended. This is something you really want to keep separate and focus on growing this pie as large as possible. So there are two ways to think about it. Calculating your retirement number. The sooner you start, the more your money will work for you. So here's how you can think about retirement. You can think about it in two ways. The first way is you can say, okay, how much money do I need to have to say, okay, I can stop working? Hypothetically speaking, this is just hypothetical. Let's say you said, I need $500,000 at retirement, and that'll cover me. So if we use an example of earning an average return of 5% per year, and we look at it from a different age, the amount you need to contribute monthly changes based on your age and how long you have to retirement. So if you're 30 and you want to have 500,000 at retirement at 65, you need to invest about $440 a month. At age 40, that pretty much doubles. At age 50, it doubles again. So the point I'm making here is that to get to the same dollar figure, you either have to increase your contributions depending on your age, or you will have to earn more on your investments. And there's only so much you can earn on your investments without basically gambling. That's why I put in an average annual return of 5%. I believe that's fair and that's about average. But you do want to consider how much you need to put in to get where you want to be. The second way of thinking of it is how much you need to retire based on your desired monthly income. So hypothetically speaking, if you wanted to take out a monthly withdrawal of $2,500 a month, assuming the funds that you have, the lump sum of funds you have earns an annual 2%, you need roughly $589,000 at retirement. If you want to take out $3,500 a month, you need about 800,000, and 5,000, you need about 1.1 million. Now, this is based on a time horizon of 25 years. So this model uses the concept of you retire at 65 and you have income every month for the next 25 years. This is what you would need at retirement at 65 to make this in desired monthly income. So just something to keep in mind. These numbers are something that you can, well, you can actually find retirement calculators online, or you can just call your financial advisor and they'll be glad to help you. For some of you, that may be me. So if after the call, please, I'll be happy to help. Now, in terms of sources of income in retirement, it's not just your pension plan you want to think of. You can think of any other option that's available to you. It may be an individual retirement plan, other savings, like I said, national insurance. If you have real estate, these are all things that can pay you income in retirement. So you want to think of your retirement picture holistically and not just from one aspect. It's not just your pension plan, but that is one of the I would say maybe the easiest ways to build up your retirement savings. Especially ask the right questions. If Figure out, is your pension plan mandatory? Is it defined benefit or defined contribution? If it's defined contribution, that means you have control over your investments. Figure out what your employer match is. If you contribute 5% of your salary and your employer contributes 5% of your salary, figure out if you increase your contributions to 6%, if they will match that. If they will, that's great. It's technically free money. But you never want to leave that kind of opportunity on the table. You want to find out if you can make voluntary contributions. Like I said, if you're perhaps in your 40s or 50s and you want to play catch up, then this is a great way to do it. And even if you're not in your 40s or 50s, even if you're in your 20s or 30s, making additional voluntary contributions is not bad at all. It just puts you further ahead. Figure out what the plan is invested in. Like I said, understanding your asset allocation, what risk you're comfortable with. Um, you know, if you are comfortable with taking a lot of risk, then go more aggressive. If not, stay more conservative, whatever. But the point is just to figure out what you're actually invested in and have an idea of where you are. Because the one thing you don't want to be is you don't want to be invested too aggressively near to retirement. So for example, last year, global stock markets were maybe down like 18% or so. If you were invested very aggressively, you could have lost a good portion of your retirement savings right before retirement if you were positioned very aggressively. Conservative portfolios were down also, but they were down significantly less than aggressive portfolios. So you do want to keep that in mind and understand that as you approach retirement, you want your asset allocation to be more conservative and less risky and have less fluctuations in the overall value. And then also figure out what happens if you leave the company or retire. So if you leave, do you get your employer's contributions? Or if you retire early, do you get your employer's contributions? Figure those out. Figure out your vesting period, how long it takes for you to be able to access those. These are all very important questions you need to ask. Also, you want to consider three things. Longevity risk is very key. One of the things you'll notice is that people are living longer today. I can imagine that in 50 years from now, the average life expectancy may have increased by a few years. The future is difficult to predict, but you don't want to be, I guess, you don't want to make a plan for, okay, let's say I plan to live 20 years beyond retirement, and then you end up being 95 to 100 years old and realize, oh, shoot, I don't have no money left. So um, expect the unexpected. It's much better to invest more than you need to rather than to invest less than you need, especially considering that even though you may not have debt anymore, the chances are as you do age, your medical expenses may increase and insurance premiums increase, stuff like that. So you want to factor all of that in. Now, creating an education fund. Uh, I wanted to add this in here just to highlight something that I think is very important. A lot of people think when they hear, saving for college, they take it just for what it is, and they actually save for college. Um, I think that's good. It's not bad. I'm not going to say saving's bad, but you can. There are ways to make sure that if you have kids, that they can get to college with more money than you would have planned outside of savings. So hypothetically speaking, right, if you have a child and she is 3 years old and will attend college in 15 years, you invest $200 per month and earn 4% per year on average. Your investment earnings would be about $13,000 versus your total saved of about $36,000. Now that $13,000 makes up over a quarter of the total value in 15 years. That extra 13 years, like 13,000, that can be, another year or two of college, depending on what else you have going on. But it's very important to think that, you may be able to invest for college instead of saving. Now, one of the things I like to encourage people to do is also to think outside of the box when it comes to creating an education fund. It doesn't have to specifically say education fund. Um, think about it in terms of different strategies. So number one, you can invest in a mutual fund, right? That's pretty standard. Two, you can use your pension plan. Like I said, if your employer allows voluntary contributions and voluntary withdrawals also, what you could do is treat your pension plan as as another vehicle for saving towards, your child's college expenses. I typically you don't want to mix the two, but um, this is low hanging fruit in terms of something that's easily attainable. It's something that's already coming out of your salary. It's something that will be segregated if you think about voluntary versus your mandatory contributions. It's a vehicle that you can use, and I think it's actually worth exploring. Life insurance, this is just not as necessarily a plan, but as a backup. You do want to think about life insurance if you're planning for your kid to go to college. If something does happen to you, a life insurance policy can make sure that that's still an attainable goal for them if something were to happen to you. And you can also think about annuities. So there's multiple ways that you can think about saving towards college or investing towards college. But one thing I will say is that be mindful of any tax implications that may arise. I know in the Bahamas we don't really have income tax, but in terms of insurance policies with cash value and annuities and whatnot, there may be penalties for tapping into those early and whatnot. So definitely understand what you're getting yourself into. But the point here is just to, keep an open mind of how you can actually um, invest for college without going the typical route. And plus is that obviously, you have higher earning potential with your investment earnings. It's flexible. There's coverage for unexpected events. It reduces the burden of student loans, which can be costly for your children. And depending on your jurisdiction, there may be tax benefits. I know in the U.S., if you have a 529 plan, up to a certain amount, depending on the state, you can actually deduct that amount from your taxable income. So think about all of these things when you're thinking about planning for college. Now we come to the ending part, which is creating a budget, which is where we tie all of this together, hopefully. So what is a budget? A budget is a financial plan that allocates future personal income towards expenses, savings, and debt repayment. It doesn't mean you're cheap, it means you're financially responsible. Um, One of the things people have a misconception on is, someone will ask them, hey, you want to do this? And they say, no, well, I'm on a budget. And it sort of has like a negative tone to it. It shouldn't at all. I think one of the um, common misconceptions is that, a budget should not be considered an extracurricular activity. A budget should be considered something that's a very, very, very important part of your life and something that you actually do pay attention to. It's not something that you just set and forget. This is something that most people probably don't do, but most people should do. Um, like I've said, it's a key part of developing good financial health. It gives you a visual account of where your money goes. Most times, trying to keep all the stuff in your head, it gets lost in translation. It helps prevent overspending. It helps you with preparing for emergencies, and it helps facilitate long-term planning. So a budget is definitely something that I see as mandatory and not something as it's not just something that's fun to do, I would say. So how do you create a budget? First, you figure out your income. You can't know what you can spend without knowing what you make. Next, you figure out your expenses. Then you set your goals and you adjust your habits accordingly. It's very simple, very straightforward, nothing too complicated. But I'll walk you through ways you can get this done. So one of the rules that most people or many people use is the 50-30-20 rule. And this is basically how you allocate your income um, in terms of what you want to spend it on. So 50% goes to your needs, 30% goes to your financial goals, and then 20% goes to your wants. Now, needs versus wants, everyone is going to say, certain things are mandatory, other things aren't. But when I say needs, I'm talking about, food, shelter, utilities, maybe insurance, stuff like that, that's mandatory. When I say wants, I'm talking about Netflix, jewelry, entertainment, stuff like that. And financial goals, obviously, savings, emergency savings, investments, college savings, stuff like that. So what I'm going to do right now is I'm actually going to share my screen so you can see a sample budget that I have in an Excel document. And I'll actually drop this in the chat also so everyone can see it. But so this is a sample budget. Let me just get feedback from someone. Can everyone see my screen?
Yes,
Oh,
we can see your screen.
okay. Let me just
Hello.
maybe zoom in a little bit on this side. Okay. So this is a sample budget. This is what it looks like. So your first step would be to figure, like I said, figure out your income. So hypothetically, let's say you have a salary of $4,500 per month, right? Additional income is zero, just for the sake of the argument. Now let's look at your expenses. These are pretty much your needs. So let's say your rental mortgage is around $1,350. You have an auto loan of $150. Your electric or utilities is $150. Groceries is $500. Hard to believe in the Bahamas, but anyway, gas about $100. Cell phone $50, internet, insurance. Some people will argue that internet isn't a need, but I think, especially after COVID, and considering a lot of people work from home, I think internet has now become more of a need than a want in most cases, especially if you think about kids in school and whatnot. So I think it's definitely a need. Wants, like I said, TV, personal care, entertainment, travel, miscellaneous. And then of course over here we have your emergency fund, which is $450 a month, investments $450 a month, and then left over you have about $100 left over in cash. So this is just an idea of what a budget can look like. I have a pie chart over here that shows, okay, your needs are roughly 50%, 54%, close enough. Total wants about 23%, and your total savings and investments is 20% or so. So just something to keep in mind. Like I said, I will drop this in the chat for everyone to have and potentially, put their own needs and wants in, and you can budget on your own. Hopefully that is helpful. But this is something that definitely should be used by everyone. Like I said, this is not to be treated as an extracurricular activity. This is something you should be doing every month. Or let me not say every month, or whenever your pay cycle is. You get paid weekly, maybe you have a weekly budget, bi-weekly budget, whatever makes sense. So let me quickly jump back to my presentation. Just to wrap up, like I've said, budgeting is a non-stop process. You prepare, you create it, you implement it, then you review and go over. There are times where you're going to find that you have to make adjustments in your budget. Try to make those based on needs and not on wants. If you have, if you do get a salary increase, don't necessarily inflate your lifestyle. You want to be aware of lifestyle creep. Lifestyle creep is basically when your expenses rise as your income rises. If you can manage to, get by on the same income even as your salary increases, you'll be much better off. That extra money can go towards retirement and put you in a much better position. If you're young and you have the opportunity to invest more, that could possibly lead to early retirement. There's a whole lot of things that can do for you. So think about it in that sense. Some more tips: just keep it simple. Use less cash. I know me, a lot of times I like to use my credit card because it gives me a track record of where I spend my money. Sometimes, if I take cash out the ATM, by next week it's gone. I'm like, I don't know where this went. So sometimes it's good to use less cash. It's good to automate your money also. If you can set up automatic transfers to send funds straight to your savings account or into your pension plan, that's great. Think twice about large purchases. Don't just buy it because it's in front of you. Sleep on it, come back to it. No impulse buying. Plan your meals, track your progress, and be realistic. Now the numbers I put on that on that Excel spreadsheet, they're not meant to be realistic. It's just a guide. It's not meant to say, okay, rent is $1,300, because I know we're in different jurisdictions that may very well not be feasible where you are. The point is just to give an example of how this can work and how you can make it work for yourself. Lastly, one of the questions I often get is, how do you know when to save and when to invest? The difference mainly lies in your time horizon and the level of risk. So to simplify this, saving is for short-term goals, investing is for long-term goals. And long-term is typically beyond 5 years. So for short-term goals, you want to create an emergency fund with several months expenses, in case you lose your job, you have a medical emergency, something like that. And then save towards large purchases you'll make in the near term. So if you plan to buy a car in 6 months or a home in a year, maybe you save for a down payment. These are things where you want to save and perhaps keep your money in the bank. This is not something where you want to throw your money in the stock market. because if you do need access to the funds, then the value of what you've contributed might have declined, or it may not be readily available. Saving is low risk and low return, but it contributes to short-term financial stability. Now, for investing, like I've said, retirement planning, college education, these are things you want to invest for. Let your money work for you. You'll have to work. You'll have to work much less. Put your money to use. It comes with risk, but it helps maintain your purchasing power over the long term. Remember, we spoke about inflation. Saving won't help you beat inflation. Investing will. And it contributes to your long-term financial stability. So, like I've said, save for the short term, invest for the long term. I think I've said a lot now, and that's the end of my presentation. So I hope you all enjoyed, and I will take any questions, if any. What do you think? God, I put everyone to sleep.
Thank you, Kriston. Well done.
Mhm.
I got a lot of great information from you. Thank you.
Welcome. I see someone has a hand up.
Yeah, sorry. So I look forward to receiving that budget template. I actually have a budget, but it's nice to see it in pictorial form.
Mhm.
And then the question is, I know there's used to be a recommendation of you always having liquid 3 to 6 months of salary. Do you still recommend that, or how do you feel about that versus investing and saving or holding in case of emergency?
Absolutely. I think saving 3 to 6 months of investment or of salary is definitely something you should do. I think if it's one thing we learned from the pandemic is that, anything can happen. There are a lot of people that, were caught off guard in the pandemic, but they may have lost their job and, didn't have sufficient savings. I know in the Bahamas, I think the average person does not have, $1,000 in the bank. So if you are able to do that, I highly recommend you save 3 to 6 months expenses or enough so that if something were to happen, you can at least, survive and pay your bills for a few months until you figure things out. Versus investing, you kind of want to balance both. But both are necessary. Remember, saving is for the short term, investing is for the long term. So you don't want to sacrifice one for the other. You kind of just have to figure out a way to balance both. But once you do have, maybe 6 months of salary saved up, I wouldn't say you need to, keep saving money nonstop. I mean, maybe throw that extra into investing.
Thank you.
You're welcome.
There was a question in the chat as well. Are we receiving both the presentation and budget template via email, or how we can access both?
Yes, I can send out both.
Okay, thank you.
If I'm correct, Janae, you have everyone's email who'll be on the call, just in case it doesn't get through here.
Sorry, and another question in the chat is,
Mhm.
what do you think about placing funds in registered stocks?
Great question. So for those who don't know, I believe you're talking about Bahamas government registered stocks, so government bonds.
Yes.
If that's what you're referring to, yes. There's two ways to look at it. One, it's a good investment. You get a good return. It's fairly stable. You're backed by the full faith of the Bahamian government, so your money for the most part is pretty secure. You get your interest payment, and then when it matures, you get your principal back. Excuse me. The only thing reason I would caution against it sometimes is because people assume that, okay, I buy a 30-year government bond at 6%, right? I get 6% for 30 years. That's great. You get a stable 6%. The only thing that people miss is that the cash that comes in is not automatically reinvested. So that's where I think a mutual fund actually has an advantage, because if even if you only get 5% on a mutual fund, if that's reinvested over the same 30-year period, you're actually going to get more than you would have gotten off of the 6% government bond over 30 years if those funds aren't reinvested. A mutual fund kind of takes the work away from you, whereas you don't have to, do anything, and the funds are automatically reinvested. So any interest and dividend payments automatically get poured back into it. So I guess just think of it that way. The government bond is not bad. It's great for income if you're someone who's retired and you don't really care too much for the reinvestment. Fine. If you're going to use the income to actually live off, great option. But for someone who is further away from retirement, I would consider looking at a mutual fund that can maybe get you at least 5% or so, and that'll take some of that reinvestment risk away. More questions?
I would just like to make a comment before we leave. And one of the biggest impediments to achieving financial security or financial stability is the use of credit cards. Whilst they can be very useful items to have in one's financial arsenal, you paying anywhere from 15 to 22% interest, and a lot of people use credit cards recklessly, which really prevents them from achieving their financial objective. So, to everybody on this call, I would just want to caution you on the use of credit cards and keeping large balances on a credit card, as opposed to making a deliberate attempt to pay down the principal. So that's my 2 cents for the day.
Thank you. That's very much a good point. Something I do want to add to that, though. Um, you're completely correct. If you have a credit card, the reality is people do have credit cards. So people are going to have to, figure out how to balance that. But one of the things I would recommend is if you are going to use a credit card, at least let it pay you something. So for example, I have a credit card that gives me flight miles for every dollar I purchase or purchase I make with it. That can actually be beneficial. I pay it off every month. I think it's useful. I know other people who do the same. I think I have enough points built up now for pretty much a free trip. So I'll be going somewhere this year, pretty much for free for the most part. But the point I'm making is if you're going to use a credit card, like Mr. Gibson said, pay it off as soon as possible. Don't, hold a large balance on it, and be careful with how many of them you have. But if you're going to use one, at least get something for it. You're going to spend the money anyway. I spend it on things that are, normal, just paying bills, utilities, groceries, stuff like that. Those are expenses you're going to have to make anyway. If I can get rewarded for it, great. So yeah, I think I saw someone had their hand up just now.
We also have
Hi.
another
Oh, sorry.
question. Sorry, go
Hmm?
ahead.
Go ahead.
Hi, I didn't have my hand up, but just in relation to the credit card, I have a practice of paying it off at the end of the month. And so, I understood that worked to avoid getting, any interest, right? Because if it's paid off
Mhm.
by the end of the month, then there's nothing to add interest to,
Correct.
right? Okay.
Yeah. You want to pay it off before your cycle restarts. I guess you can probably either call your bank or check online banking to see when your actual statement ends and figure out what that date is to make sure you pay it off before then, because you don't want to carry a balance month to month. And usually it's not always like the last day of the month. So if you wait till then, you might have missed the actual date when you should have paid it off, and you would have carried a balance over and you would have been charged for it. So just pay attention to those dates.
We have another question in the chat. Can you recommend some companies we can start our investment portfolios with?
Wow. Well, you are in luck. You are in luck. I just so happen to work for one. Wow, what are the odds? Yeah, so I mean, you can always give us a call, CG Atlantic Pension. I'm not going to recommend anyone else, obviously. So I would say give us a call. Now, Grant, I'm not sure what jurisdiction you're in, so I can't say that with certainty that that applies. But if you're in the Bahamas, Bermuda, or the Cayman Islands, then yes, definitely give us a call. You can look at getting a pension plan with us. And even if you're in another country, I mean, I think we may be able to facilitate it. So give us a call anyway, and we can find out. I see a question in the chat. What is
last question. What is your
my
take on
take on
annuities?
I think they can be useful. You know, it really just depends on where you are. I know sometimes the rates on them can be pretty low. So it really just depends on what you want. I mean, if you want something that's pretty stable, you don't have to think about it. You say, hey, I just want to give you money and I get this money back every month, so on and so forth. Then sure, great, that works. Just be cautious about where you go. Make sure it's a reputable company, and understand what you're signing up for. Understand if anything will fluctuate. Understand if there are any penalties for withdrawing anything. Just know what you're getting into. But it's not a bad option at all. It kind of takes a lot of the work away from you, whereas you just pay for it up front and you get your money every so often.
Okay, so that was the last question in the chat. Thank you so much, Kriston. This was a wealth of information. I feel like we need a part 2.
No problem.
For those looking to access the information, we have recorded this session and it will be on the CG Zest Wellness resource page. I can also send out via email, but I don't have all of your emails of all the members in this call. So if you would like that information via email, please put your email in the chat and I will be sure to get this information to you. As well as if you have any other questions related to the presentation, feel free to reach out to Zest Wellness AMI at cgcoralisle.com and we will put you in touch with Kriston and the CG Atlantic Pensions team. Thank you all so much for joining and I hope you have a great day.
Thank you, everyone.
Thank you.